The Fed just slashed rates. What do you need to know?
Brian, I am so excited to talk about this because everyone is asking us the question, hey, I heard about rate cuts. It's going to happen. It's not going to happen. 0.5%, 0.25%. What does this mean for the long term? And I just love that we get to sit here and speak into that, kind of at least educate you on what took place, and then also talk about, okay, well, practically and realistically, how does this impact your financial life?
Yeah, I think it's pretty exciting. You guys, the Fed started meeting 17th, but they made the announcement on the 18th. It was, I think every mobile device I owned kind of blew up when that happened because I started getting notifications from everybody. And then at the last minute, I mean, all predictions were they were cutting 0.5%. But for some reason, a few days before, the rumor was it was only going to be 0.25%. Sure. And then the market started having a little volatility from that because let's face it, the market has priced in this 0.5%. And so when it came to be, there was a big spike if you watch the intradays on the markets, but then it kind of came down a little bit, but we've leveled out. And overall, I think you'll find that the market likes when we're in this rate cutting environment. And Bo, I wanted you to kind of walk through, why did they cut the Fed rate? What is the responsibility or what are the goals of what the Federal Reserve is trying to do? And how does this actually impact everybody?
Yeah, when we're talking about rate cuts, we're talking about the Federal Open Market Committee sets its target for the federal funds rate, which is the rate at which lending institutions can borrow from one another. So it's not like, oh, rates cut, that means that savings rates go down or mortgage rates go down. It's not that rate. It's specifically a target that the Fed uses to impact monetary policy. Well, I think setting some context is important because if you remember, rates were at near zero for a long, long time. And then coming out of the pandemic, coming out of the 2020-2021 year, the Fed began increasing interest rates. And I think it started right around, what did we decide? It was around
March of 2022.
March of 2022, they began raising rates as a means to potentially slow down inflation. And they continued to raise rates all the way up until July of last year.
Yep, exactly. And what I think is interesting is that this naturally, when you have the Fed raising rates, realize the cost of doing deals, the cost of business gets more and more expensive. This is part of the reason the Fed is doing this to try to fight inflation, but it does have that impact of slowing and cooling down the economy. So it's somewhat promising that maybe the environment for business is going to get a little bit better with lower interest rates.
Well, generally, when borrowing rates come down, it's easier for people to borrow money, both businesses and the consumers, which in theory can stimulate the economy. You get more money moving around. And the Fed has this very unique balance that they're trying to strike. On one hand, they want to slow down inflation to protect consumers. I mean, obviously, we've seen inflation over the past couple years get kind of out of hand, and then it seems like maybe it's leveling off now. But in doing that, they also want to make sure they keep the economy growing. So I want the economy to grow, but not too fast. And we want to make sure that we slow down inflation, but not too fast. It's a hard charge to figure out how to strike that balance.
You can imagine this is a hard task because you're trying to reach equilibrium, but this thing's a seesaw because as soon as they raise rates, you can tell the economy faces a headwind. When they lower rates, yeah, everybody gets excited. We all cheer because it's kind of a sugar high. It is interesting. When you look at what happened with inflation, though, this is where I told the content team, they didn't listen to me, but I think that they should have had a sword, like a Thor type person slashing through inflation. Because look at this, from September 2021, this is the exact same time period kind of as that previous chart. You can see inflation was running rampant, and it is kind of nice to see.
Hit almost 9%.
Yeah, and that's when you saw those those big steps up of raising interest rates as they were directly trying to crush this inflation. It's kind of nice to see it level out.
And then if you think about, they're targeting about 2% inflation, and right now we're at 2.53% as measured year over year. So they are at target. So it'll be interesting to see what happens through the remainder of the year. But inflation, remember, is just one piece of it. They also want to pay attention to economic growth. And so when you look at unemployment has tricked up just a little bit. Their target is somewhere between 3 to 5%. And right now, unemployment is at about 4.2%. So the question then becomes, all right, we saw our first rate cut. We saw our first 0.5%. what does that mean for the rest of the year and how is this going to look? And so the Federal Open Market Committee actually released their predictions of where they think that rates are going to land. And what you can see, and each of these blue dots, if you're out there listening in podcast land, each of these blue dots represents what one of the members of the FOMC thinks that rates will be at the end of the year. And while there's not a consensus around exactly what rates will be, I think it's pretty clear to see that it seems like rates are going to decline. They'll likely be lower at the end of 2025 and then likely even lower at the end of 2026. So we're probably going to see rates continuing to fall.
Yeah, I thought that if you watching this on YouTube, look at whoever was the intern or whoever was designed with putting the votes of the members or the predictions, they all have shapes. I mean, we have on the 2024 prediction, it's between 4 and 5%. It looks like a bird. And then if you look at 2025, this is for the people who are listening through the podcast, it's right above 4%, all the way down to slightly below 3%. Looks like a teardrop because those are tears of joy.
Yep.
And then if you look in 2026 predictions, I don't know how the intern got them to vote this way, but it looks like it's an arrow. I mean, where the majority of people are actually hoping it gets below 3%, but there's still quite a few that are somewhere between 3 and 4%.
So I think the big takeaway is no one knows exactly what's going to happen with rates or exactly the pace at which they will decline or the gravity to which they will decline, but it seems like they're going to continue moving down. And so practically for you out there listening and for us sitting here, the real question becomes, okay, what do rate cuts mean for us? Like, what is the practical and real implication as it relates to my army of dollar bills? Is this a good thing, a bad thing? What do I need to know, and how do I need to shift, pivot, or adjust?
I know we have a chart that will show this in the short term, but I don't mind because I've been looking at some of the social media. I'm like, that's quite clever. A lot of people are posting historically for the markets, especially the equity marketplace. And if you look at the historical returns of the S&P 500, is pretty big returns 12 months after this. Now, that doesn't mean that's for sure what's going to happen. But now if we bring it back to what's happened for us, the market seems to like it. It's up 1.5%.
Yeah, if you look at just since the rate cut, the market's moved in a positive direction. Even you look over the last month leading up to the rate cut, it seems like the market was excited and looking forward to the rate cut as though it were time. And rates had been high enough for long enough that the market was excited about rates coming in. But remember, the market is a forward-looking indicator, and it also digests information that it thinks is already going to happen. So perhaps some of the rate cut was already factored into some of the positive returns we've seen this year. We don't know exactly what the market is going to do over the next 12, 24, 36 months, but it certainly seems like the rate cut was a welcome thing to the markets, and they've responded positively since then.
Yeah, but this is now probably, let's get into the details a little bit. How does this actually impact you? So we wanted to go through each one of these categories so you can go ahead and start preparing, going ahead and implementing, and making sure you're adjusting your financial life to what this whole Fed movement even means for you.
So I think the one that's the easiest that most people start getting up in arms about is, oh no, I've been in this time where my cash has been making over 5%. Rates have been high, and I love seeing those interest payments, those dividend payments coming in. Does now that rates have been cut, does that mean that all of a sudden all my yield on cash is going to go away overnight?
I do think it's kind of interesting because the markets are somewhat, they anticipate what they think is going to happen. So anybody who looked at CD rates a month ago, it was not hard at all to lock in greater than 5%. I think it's now interesting, and I started seeing this trend about a week and a half ago. It was now getting increasingly hard to get over 5%. Everything was in the high fours. We haven't seen any dramatic changes, but I think you are going to start noticing nudges below where it was easy to get 5% of your cash. Now you're going to be in the high fours. And I think that's something just to be mindful of. And remember, you're going to see money market mutual funds are going to continue to be the high flyers above the high yield savings accounts for a period of time. But there will come an interest rate cut where all of a sudden you'll have the crossover point where those high yield savings accounts will likely be better than the money market mutual funds because they're going to react much, much faster.
So when I think about how I might change my own personal cash management, I don't know that I'd get in a super big hurry to jump back and forth between different institutions and go try to chase the yield. What I would do is I would go pick a provider that generally stays towards the top of rates. Whether I'm using money market mutual funds or high yield savings accounts, I would pick one of those companies that generally stays at the top. And while I may not have the very best perfect rate today, odds are I'm still going to stay up in that upper 10 to 20%. If I can do that over the long term, I'm still going to have my cash working for me. I would be careful and I would be hesitant to just start bebopping all around, opening a bunch of different accounts, because I'm nervous that the juice in doing that may not be worth the squeeze that it requires.
The hassle factor.
The hassle factor.
Let's talk about mortgage rates. This is something that I think everybody was, if you don't completely understand how all this works, it's like interest rates drop, you immediately think of mortgages. But let's be clear here. When the Fed lowers rates, this is an influence on the mortgage rate environment. It is not a direct correlation.
That's right.
Now, because if you think about it, what mortgage rates, traditional mortgages like 15-year, 30-year mortgages are more closely pinned to like the 10-year Treasury bond. But it is one of those things where you are starting to see a trend where, like I said, it influences. And the market has been anticipating the Fed is going to start cutting rates. We're going to be in a lower interest rate environment going forward. And the market rates of mortgages have reflected that.
Yeah, you can see that rates have dropped. I mean, from May 2nd of this year, fixed mortgage rates were about 7.22%. And here we are now, week of the rate cuts, they dropped down to about 6%. So we are seeing a little bit of reprieve in mortgages. Our guess, our assumption would be if we continue to see rate decreases happening, that we'll continue to see mortgages begin to decrease. Now, I don't know if you're someone sitting out there who has a 6.5% or 7% mortgage. I don't know that we're going to go back to 2.5%, 3% mortgages. I mean, maybe, but
no,
I think that was more of an
outliers.
outlier. I don't think that that's going to be the norm. And so you need to pay attention if you are someone who recently bought a home in the last 12 or 24 months. You probably are thinking about, man, okay, as rates drop, should I be thinking about refinancing? Is now the time? Well, we actually have a tool that you can use. You can go out to moneyguy.com/resources and download our refinancing guide that will walk you through how to determine, should I refinance? And if I should refinance, when is the right time to refinance? The general rule of thumb historically is that when you refinance, you want to save at least 1% on your mortgage rate. If you can do that, the interest savings will likely compensate for all the closing costs you would incur to refinance. But if I were someone, this is me personally, if I were someone sitting at a 7% mortgage or a 6 3/4, and rates are now at 6, I might be thinking, okay, the Federal Open Market Committee has said that rates are probably going to continue to drop a little bit more. There might do a few more rate cuts over the next 6, 12, 18 months. I may hold steady before I refinance so that I might be able to get to something in that like 5 to 5.5% mortgage range. That's the way that I would be approaching it.
But don't skip the math. I think that's what I love about the fact that we actually have this resource. If I was even sniffing around the idea of refinancing, I would definitely go to moneyguy.com/resources. Check out, we actually share with you how to do the math to figure this out. And then don't sleep on also rate modifications. This is
huge,
a little known thing that most people skip out on, and it should be step number one, even in your journey of refinancing. Call your existing lender, and instead of going through the costly expense of getting a new mortgage company, all the recording fees, all the attorneys, and all the other governmental fees that your local government's charging you to record all this, call your existing lender, see if they offer a rate modification to keep you as a customer, and then it might only cost a few $100 at most, but you get the benefits of the lower interest rate environment.
Now, I know another question that a lot of people are out there asking is, man, student loans are a very different issue today than they were perhaps 15 or 20 years ago. And student loan rates have been creeping up along with the rates of most other borrowing. And so a lot of folks are asking the question, okay, if rates continue to fall or if rates are lower now, should I be considering consolidating my student loans? Should I think about refinancing my student loans to try to get that rate down to have a more manageable payment, more manageable repayment term? Yeah. What are your thoughts on that?
So student loans is one of those that definitely could benefit from this, but we want to be careful because if you have a student loan that is, a public student loan, you've got to be careful that you don't walk away from the PSLF.
That's
now,
right.
when I talked about this in our content meeting, when we say PSLF, we're talking about the public student loan forgiveness. It's not pumpkin spice latte. It's fall, y'all. That's what, because that was one of the suggestions that was thrown out, in the content meeting. And then Bo, because I'm horrible at acronyms. I pick on Megan all the time because she's our acronym queen because she comes from education. IDRs are what?
They're income-driven repayment plan. So if you're someone out there who has a special student loan that qualifies for a special type of repayment, you just want to make sure that you educate yourself on what might happen if you were to consolidate, if you were to refinance those loans, because not all student loans are created equal. While there may be benefit in dropping the rate, you want to make sure that you're not foregoing some other benefit or some other program that you're currently participating in. So like most things, before you do it, you want to make sure you measure 2, 3, 4 times. So that way you understand exactly what's happening inside your financial situation. What you don't want to do is chase the short-term, temporary relief and actually end up costing yourself more over the long term by not recognizing what you were giving up when you chose to refinance those loans.
I want to talk about the big picture because I think the only thing that I get nervous about when the news cycle focuses on the Federal Reserve and all the things that are going on in the economy, these are definitely things that should influence your financial life, but you should have a plan that's completely independent of these outside voices and influences because, Bo, you say it's so best when we get through any type of volatility in the market and we start talking to clients, you're like, look, we're trying to create a plan for you that's good before the volatility. We have a plan that's good during the volatility and a plan that's good after.
That's right.
That takes a little extra homework to know what is your purpose, what is the goal of this money, because it is only a tool. How does that intersect with your risk profile, your age, all the goals? And then, of course, take into account what interest rates, what taxes, and all these outside influences so you can optimize the plan, but don't lose focus or skip out on the homework of actually doing the big plan so that you can control that.
And then focus on the things that you can control, like living below your means. Always be buying, dollar cost averaging in the market, maintaining a healthy emergency reserve and staying calm. Even if we see volatility and we have more rate cuts and we're moving through an election cycle, even if the market is not as positive and rosy as it is right now, recognize that's the very reason why you put the plan in place that you have.
You skipped a big one though.
What I skipped?
ABB. Always be buying because that will protect you from making these emotional things. Like when you talk about the economy, when we talk about elections and all the political craziness that's out there, ABB is your friend. Always be buying. Set it up on automation so that you can actually own your life that much faster.
You skipped one.
Uh-oh.
You know one of the things you can do to make sure that you keep your financial life on the track. So you can subscribe right now to this channel to make sure that you know every time we're putting out new information, because we love that we can develop and curate this content and get it in front of you. But we also love that we can answer your questions. We can speak to the things in your life that you care about, that you want us to weigh in on. So right now, we have the team out in the wings collecting your questions, and we want to load you up because we believe that there is a better way to do money, and we want to show you how. So with that, Creative Director Reby, I'm going to throw it over to you.
Oh, yeah. I've got some questions queued up. Keep them coming in the chat. Thanks for being here. Thanks for submitting your questions. It's always fun to kind of look through them. But we're going to kick it off with Genuinely Foo's question. It says, Charlie Munger is known for saying, get to 100K ASAP. My wife and I are 28 and have over 200K invested.
Nice.
That's across a 401K, a Roth IRA, HSA, and brokerage accounts. Would this grow quicker if it was in only one account?
Man, it's so funny. I get this question a lot, and people think that because I have different accounts, those different accounts might grow at different speeds. Now, look, if you're going to get like super academic, yes, there are tax implications on some accounts, and those tax implications can create what's called tax drag that will impact your rate of return. But let's zoom out from that for a second. If I have 5 different accounts, and in those 5 different accounts, I buy the S&P 500 low-cost index fund. Guess what? All 5 of those accounts are going to perform the same way. They're all going to have the exact same performance. The account is just strictly the vehicle that holds the investments that are growing my dollars. But I do think that Genuinely Foos has an interesting question. A lot of people see this. Their financial life gets so spread out, and they end up having 10 different pieces working, or 10 different accounts, 10 different things, doing 10 different things, moving in 10 different directions. Well, when that's the case, it's really, really difficult to have your money working as effectively and efficiently as it can. We always use the symphony illustration. If you have an orchestra and everyone is playing on a different sheet of music and you have all these different instruments, it's not gonna make beautiful music. But if you can get all of those instruments and all of those musicians playing on the same sheet of music, moving towards the same end goal, it's gonna create something beautiful. And we think that inside of your financial life, you can do that. So I don't think that Genuinely Foods needs to be worried about having multiple accounts, so long as they understand that those multiple accounts need to be working together towards the same objective.
Well, I do have, by the way, G-Fu, you're rocking it. I just want you to know that. But let's talk about, because your behaviors change as your life kind of grows and blossoms into more complexity and more exciting abundance. In the beginning, though, and this is for all my young people who are under 30, your savings rate is so much more important than even where you're putting the money.
Huge.
And so you've obviously shown that your savings rate has been great to get to $200,000. But I still recommend for somebody, even because you have a complexity, you have multiple accounts, and you're trying to figure out how do you maximize this. And I love Bo's example with the S&P, but there's nothing wrong with you in the beginning trying to choose an index target retirement fund. And the reason I say index target retirement fund is because the index funds are so much cheaper, but it lets you just make 2 decisions. When do I need the money and how much can I save every month? And then that's all you have to figure out. And then you just buy that in all the different accounts. Now, of course, when your accounts start to get much, much bigger, we're talking about 600, 700, 800, maybe even your first $1 million when you cross into 7 figures, tax allocation is going to mean a lot, and you'll start paying attention to what you buy into each of those taxable buckets, whether it's the tax-free, tax-deferred, or even the after-tax, just your brokerage investment account. But in the beginning, let's focus on the behavior. Your savings rate is so much more important than the investments. We want to keep it as simple as possible. But that's the thing I would be focusing on. How do you get to that first $1 million as fast as possible? And I want to go back to you. You started this off with the Charlie Munger quote.
I was about to double back to it. That's
oh yeah, right. I love it because we do a lot of content, really kind of echoing what Charlie's talking about is that first $100,000, because it's for most people it's going to take you 7 to 9 years with what's considered a reasonable savings and investment rate to get to your first $100,000. But here's what's so exciting about compounding growth. Don't think linear. Don't think 1, 2, 3, 4, 5, 6. Think about it in terms of exponential growth, because the same 7 to 9 years that it takes to get to your first $100,000 is going to be the same period of time that your $500,000 is going to turn into $1 million. That's right. You're going to get 5 times the growth just because the money is going to your army of dollar bills is going to be working harder than you can with your back, your brain, and even your hands. So make sure you're maximizing the opportunity. Let your money actually start working for you. Get to work. Always be buying.
28 with 200 grand.
No, that's awesome.
It's awesome.
Yeah.
That's good
By
stuff.
the way, we'll save it. No, I'll throw it out. When you get to the point,
Boom.
work with us. This is the abundance cycle in effect right now. We're going to love on you, give you all the free advice you need, but you will reach a stage of complexity, and you'll know it. You don't even have to kind of go, am I at that point? You'll know it, because it's just your taxes get complicated, your life gets complicated. You say, oh yeah, Brian and Bo shared that with me, so I'm ready for it now.
That's so true. Genuinely Foo, good question. Thanks for being here. Glad to see you in the chat. Ted has a question for you next. He says, in light of rate cuts and by extension continued inflation, should I put money in gold beyond 25% saving and my 6-month emergency fund? I fear inflation will only return again. So what do you have to say to Ted?
Man, Ted, I'll be honest with you. I I don't love answering this question. And here's why. I feel bad. Honestly, more than I feel mean, because I have so many people who ask us, like, you can almost set your clock by it, that whenever we see volatility or whenever inflation is a concern, it always comes back to like, hey, should I buy gold? Should I buy gold? Should I buy precious metal? Should I do, should I do this? And the problem is, in my opinion, I'm going to say in our opinion, when you go buy gold, you buy a hunk of precious metal, you're buying this thing that's value changes without creating any specific economic value, right? Like the thing that makes gold more valuable is someone comes along after you buy yours and they then say, I want to pay more for that chunk of gold than you paid for it. It's not like the gold did anything. It didn't create any income. It didn't produce any product. It did not provide any service. It's simply what your peers around you assign the value to. For me, that's a harder thing to get super, super excited about when I think about I can go buy an S&P 500 index where I'm going to buy 500 different large companies in America that are creating products, adding services, changing the way that we live, creating dividends, creating interest. I just get so, I don't know that I get super, super excited about gold because of the way that the economics of gold works. But I'm going to give Ted an out because this is what he said. He said, after I do my 25%, after I'm saving, is it okay if I allocate some towards precious metals? And the thing was this, once you get 25%, you get to choose what you do above and beyond.
Yeah, when I have people come to me, and Ted's thinking about this the right way, get your underlying base assets, that's saving and investing 25% of your gross income. But after that, if you sleep a little bit better and have a little more peace of mind because you bought some gold, I'm not going to pick on you about that. It's the same thing I tell all my crypto people out there is that if you want to jump on that, because it does feel like, and I'm going to probably get hate for this, but gold is it's considered this holder of value when you get into the world's coming to an end or craziness is out there, or you get into hyperinflation. Historically, that's been the case. But I will say it's kind of interesting now that crypto's on the scene. It seems like it's gold for young people because that's the same promises, but it's got the exact same limitations that Bo was talking about with gold is that it doesn't innovate or create anything upon itself. It's counting on the only way you make money is if somebody pays you more for it, and it has friction costs because typically with gold, you have to pay somebody to keep it safe. Same thing with when I think about crypto is that you have to go through something that facilitates the transaction that has a little bit of drag or friction cost, and then you once again have to pay somebody, or I guess you don't have to pay somebody, but if you want to make it accessible to make the transactions easy. I just did my taxes. I did this whole experiment with crypto for about a year and a half. It was way too volatile to me. I lost a chunk of money on it, and so I just it's one of those things. If you're Ted, if you sleep better at night, I'm not going to pick on you for it, but I don't think that it does what everybody says it's going to do in the brochure necessarily, because I always think about if you get to the end of times or you get into these inflationary periods, how is it actually going to work? And typically, when I visualize that, it seems like it's not as great because you can't break off pieces. I guess inflation, it can be somewhat effective.
But even if I want to protect against inflation, don't you feel like there are much better ways to protect against inflation than hard
everybody
gold?
Always the stock market. I mean, because companies will raise their prices, and you will be the recipient of that higher revenue, the higher profit down the road once the inflation gets back under control.
Reeds, I have a question. Is Fool's Gold still out there? Is that no longer?
No, we hid that thing.
I don't think that was.
I was just gonna say, if you want to see how consistent we are on this, that was back in 2009.
Yeah, that's why I don't know if our YouTube channel
Maybe
still shows it.
that.
It says, "Hey, we started a YouTube channel in 2011." You know how big we'd be if we started in 2011? No, we actually put like 2 or 3 videos out in 2011. And the content's good, but it's laughable because we had not quite figured out everything.
Can we ever re-release that, or is that not?
Oh.
Is that a thing?
I mean, we can.
There's a hush amongst the entire content team.
Technically speaking.
All the chaos seekers would love for us to go re-release that stuff. Forget it, man.
Yes, there
If
is
we
an
only
infamous
lived in
video
a
where
community
Brian
where it was
talks
much
about
easier to
gold.
have video access,
Buddy.
video producers and stuff. Oh, really?
Oh yeah,
A
I think is
bloopers
it in the
video.
bloopers video? You guys reacted. Yes, it's our
We reacted
first
to it. There
financial
we go.
advisors react, and you react to your first videos. It was in celebration of when we hit 100K. This all feels like so long ago, and there is a clip of Fool's Gold in that. That's
The
right.
case in point
Good
is
call.
we've been
Nate.
pretty consistent. Like the thought process has not changed.
Yeah.
It's not like some new thought that we came up with. Pretty consistent through time.
Hey, I'll give Ted one other thing. If you're just looking to benchmark or draft off of other people's behaviors, Warren Buffett is probably the harshest critic on both of the two things I just talked about, because he even makes fun of, like, precious metal. You could fill a baseball stadium with the gold of the world, and you could leave it there for 20 years and come back and it'll look exactly the same, wouldn't have generated any more.
Yep.
So he's a harsh critic, and Uncle Warren has been pretty good at making the money grow.
Love it.
Awesome. All right, I've got some more great personal finance topics queued up. There is a collective question that I just need to mention. What's up?
Your stickers.
I
I just
just
noticed.
noticed-
I noticed
I
them this
forget about
morning's
them.
content. Is this a new edition?
Is that in her shot? I can't see her shot.
I
Is
was
that
just
in her-
waiting for Brian. You can't see
Oh,
it
I
on
saw
screen.
it.
Well, now
I
I have
saw
to
it.
show it. It was just a joke, and I was waiting for Brian to notice it.
Buckle
but
up,
can you
folks.
see that?
Look at that.
I don't know if they can see that.
Yeah, by the way, if you come to our
But
building,
I've got their
I had
faces on
somebody
my
who
laptop
ate at
today.
Obie Joyful across the street, and they said they were at the window, and they could see our big old
Just us
heads on the side of the
smiling out
building.
at
So the
them.
employees, on one of our book tours, one of my good friends in Atlanta had decided he would entertain himself and my buddies who are old neighbors of mine, and they printed huge heads of me and
Big
Bo
old
at the
fat
Atlanta
heads.
show. And they held them up throughout the presentation, and then they gave them to us, and they wrote some really nice things on the back of them. Well, somehow these things made it through the airport. They made it back. And the employees, when they saw it, they have been having a lot of fun, and they've decided they put
So
them
now
in
we
a
made him
window.
a sticker for ourselves.
I love it.
It did backfire on me because I was in a coffee shop yesterday, opened this up, and then realized,
Bo
like,
probably
oh,
likes it because he knows he's a good-looking guy. Me,
Their
I kind of
faces are on my
cringe because
laptop.
I'm like, ooh, look
Hey,
at the nose, look at the...
You know who loves giant fathead jokes? TSA agents. When you go through a pre-check, like, hey, do you have your ID? And I just pulled up my giant head. I was like, hey, you see this? Yeah, they thought that was hilarious. They loved it.
yeah, good times.
He really did enjoy those stupid things at the
Good
airport.
times.
Meanwhile,
right.
I was trying to hide under a table every time. I was like, please
Yeah,
put it
you
down.
didn't even have to carry him through the airport.
Oh, I
think
refused to
Bo,
carry. We
me,
were thrown
and
in the
Matt all
trash
carried them
before
at
I'd
some
have carried
point.
it.
What a time.
Please don't look at me.
All right, you ready for another personal finance question? Here we go. Oh, drop those.
I dropped my Ruby, you're supposed to
Sticky
be
notes.
professional. You're supposed to keep talking, and I
I
don't
just
even.
didn't know
people
what
don't
was
even know I
going
got it.
on.
I dropped my stickies.
All right. Well, let's see if I can say this username. Helicopterodactyl. Got it. He has a question for you. It says, my wife and I were 30 and on step 8 have seen our incomes increase 200+% over the past 5 years. Wow. We save a third of our income, but still feel guilty over lifestyle creep. Any advice on how to think through this?
Well, Brian, you do such a good job of talking through this. I'd love to hear your thoughts because you've been a great resource to me over the years. One thing I just want to throw out there, I'm going to say Helly, is that lifestyle creep is not bad. We get this horrible rap and people talk about how it's a negative. Lifestyle creep.
Expanding your lifestyle is not the worst thing as you get more successful.
Lifestyle creep is okay. I mean, that's what you want. You want your life in your 30s to look better than it did in your 20s, and life in 40s better than the 30s. That's okay. You just can't make it to where your lifestyle creeps at a pace that outpaces your savings rate or your wealth building rate. But lifestyle creep in and of itself is not necessarily a bad thing. So what would you tell Helly, who's had like this 200% increase over the last 5 years and still is feeling guilty?
Well, I mean, I always bring things back to a basic understanding. So you know what the plan is and you know where you're headed. Is that, remember, we always talk about make wealth. And that's that phase of life where you really got to focus on the behaviors. You got to get through the financial order of operations, because there's a lot of people that they get the tools, they get the income, but they never actually get to the process of making the wealth. And then once you make the money. You got to maintain the wealth. And then after you maintain, and that's where you'll de-risk, you'll pay down additional debts like the low interest mortgage and so forth. And then you get to this multiply stage. This is where hopefully you're a little more generous, because if you think about it, every dollar that you have, because we talk about the wealth multiplier, every dollar has so much potential when you're young, because you can maximize that most powerful ingredient of time.
Yep.
But you will get to a point on the make, maintain, and then multiply, is that after you've made the wealth, you realize, you know what, I can't take it with me. So I might as well multiply this by being generous with my charities and organizations, but also it's okay if your lifestyle starts showing a little bit, more of this. This is why in the book, when I wrote Millionaire Mission, I talked about the timing of purchases really have a big impact on the fact, and I use the example of Corvettes, and the fact that the typical Corvette owner is actually in their early 60s, and I showed that as a percentage of their net worth, it's hardly anything for a 60-something-year-old who's in the top 10% of their age category. Buying that Corvette is not a stress whatsoever. Whereas for a 20-something, which all the commercials for Corvettes will show somebody who's in their early 30s or in their 20s, it is, if you're in the top 10% for that age category, it could probably exceed your entire total net worth. So, Helly, with those understandings, I would ask you need to figure out, are you ahead of the curve, on the curve, or behind the curve? I'm going to say, based upon everything you just shared, you're ahead of the curve.
At 30, it's kind of hard to be behind the curve.
I would encourage you, go check out, if you go to learn.moneyguy.com, we actually have a Know Your Number course, so you can kind of see how close you are, how ahead of the curve you are. And then and that's also why when I designed the financial order of operations, when you get to step 8, meaning you've already done steps 1 through 7, you're saving and investing 25%, and then if you did this course and this tool of know your number, I want you to kind of enjoy life, because you never go get your 20s again, you never go get your 30s again, you never go get your 40s, and you want to look back when you get to be my age and go, man, well done. Not only do I get to live my best life in this season of life, but also I got to build a ton of great memories. I don't want you to live this miserly life where you wake up and you go, man, what was I doing? Why didn't I travel more? Why didn't I make more memories? Why didn't I invest in this type of thing with my children? Focus on that. And I had a client come by. It was actually your client that came by the studio yesterday. And they read the book, and it was the same comment that I get about the book all the time, because they've listened to all of our content, and they're like, man, I really wasn't shocked about a lot of the content, but those last 2 chapters, they popped, because that's where you really unloaded on the kind of knowing how you handle wealth, how your life and your perspective changes. And that's on purpose. And that's why I've really tried to give you guys everything I can think of. So as you go from that make to maintain to now multiply your wealth, you do it in the best way possible.
And 25% is not supposed to be a restrictor on your wealth building journey. For someone like you, Helly, it should be the thing that frees you. Once I hit 25%, I no longer have to feel guilt. If I want to take that trip or upgrade the automobile or do the home renovation or fill in the blank on the thing that you want to do, 25% should free you up so that guilt just falls off, especially at age 30. Because if you're 30 years old, saving at least 25% of your gross income, you are going to set yourself up for huge financial success in the future. I think you can let that guilt go.
Yeah. Plus, your money can multiply, it can help people, and it can, I would lose the guilt but just take a measure of yourself and how you're using it, and then let go of the guilt, because I think it's actually a blessing when you're actually able to be talented enough that you generate large incomes and are a big shovel. That means that you can probably do a lot of good with that.
Love it.
That's great. Well, Helicopter Dactyl, thanks for your question. Really good one, and I hope that helps you guys. Scott's question is up next. He says, my wife and I are listing our home this week. Using the proceeds from our existing home, should we put just the 20% down on the next one and keep some cash on hand, or put down up to about 40%? Hashtag messy middle. These are the choices that he's thinking about as they're going to their next home purchase. What do you guys have to say?
I want to let you kind of give the meat on this, but I was just going to set the groundwork is Scott, this is where, unfortunately, as financial advisors, we have to tell you it depends.
It depends.
But to give you some triage steps, I mean, it is definitely one of those things where if you don't know where you are on this process, because the depends could be the 20%, the depends could be take all 40% because you don't want to be paying that high interest rate, especially when you're this far ahead in your savings. But you kind of need to come back to where are you at in this journey to kind of figure this all out.
Yeah, first thing I would encourage you to do, we have a home buying checklist. You should go to moneyguide.com/resources and go through our home buying checklist to answer these questions about your new home. Like, what's my time horizon? What's the family situation? How big's my emergency fund? And then you got to do exactly what Brian just said in terms of triaging. Where am I today? You said hashtag messy middle. I know that in the messy middle, money might be kind of tight and things might feel pretty constricted, and maybe savings rate hasn't been what it would have been or could have been if you were not in the messy middle. So you might need some of those proceeds to be working for you, to be building for the future. If you haven't done the Know Your Number course and you don't know what your finish line you're working towards is, it's difficult to know, are you at the right starting point today, or will some of the proceeds from your current house put you on that right starting point? Because then you have to measure that with, all right, when I go to buy this house, if I only put down 20%, am I still going to be inside of 25% of my gross pay for that monthly payment? Or do I have to at least put 30% down just so I get the housing payment inside of that 25%? So you have to kind of triage for yourself where you are and which one of those decisions makes the most sense. You can't run afoul of the rules. You have to you have to make sure that you're going to be in the house from 5 to 7. You have to make sure the total housing costs don't exceed 25%. And then once you get there, then it becomes, okay, where can these dollars be best used for me personally? And if I'm in the messy middle and I'm in my 30s, am I going to be better served putting an extra 20% down to go save 6.02% in mortgage interest? That is a viable and realistic thing you could do. Or would I be better served putting that money to work? Have I gone out to moneyguide.com/resources? Have I played with the wealth multiplier? Do I know what those dollars can turn into by the time I get to retirement? And which one of those is more valuable for where I am in my journey right now? And Scott, the answer for you may be different than the answer for your neighbor. That's what's beautiful about personal finance, is that it's personal. And in this one right here, once you've made sure you've checked all the boxes and you've met all the metrics, then you have to decide, okay, makes the most sense in my unique and specific situation.
Don't skip the homework. Actually do the work, figure out how you maximize this moment, because this is a great opportunity. I just don't go off just the gut. Actually do the homework, do the things that Bo gave you all the kind of, he laid out the roadmap so you can maximize this moment.
Now, there was a little Easter egg in there that I want us to address because I think some people missed this. He said, should we put down 40% or put down 20% and keep some cash on hand?
Yeah.
Right? So here's what you cannot do. And I'm going to say cannot do. You can't go buy a house and burn all of your cash. We see far too many people do this because you go get in the house and you use every bit of your savings and then you got to put blinds on the house, or you got to go buy a lawnmower, or, oh wow, you didn't realize property taxes were about to get or whatever the thing is. Whenever you go to buy real estate, especially if it's your primary residence, you have to have an emergency fund in place, and you cannot spend that emergency fund down, or you will be swimming
naked.
And when you're swimming
naked
and the tide goes out, that's when you get exposed. So you don't want to put yourself in that situation. You have to make sure that you keep cash on hand for an emergency.
Bo, I had two exciting things that I've noticed before we get to the next question.
I'd like to hear both of them.
I was kind of shocked. We've been on a roll here recently. It's not like you get to say, hey, you know what? I'd like to have something go viral. It just kind of happens. You don't know. You never know. Like, I'm still shocked that the whole private chef thing has done what it's done.
It still makes no sense to me.
But okay.
Thank all 6 million of you.
And then I think we've had a Dave clip that's now seemed to have caught some traction, and as a result, we are. I mean, literally, it could be days, it could be a week 500,000 subscribers.
It could be right now if every single member in the live stream decided to subscribe to the channel. Think about that. That could happen presently.
The other thing is, I think it's, I wish you guys, I even told the team, what I'd like is that Bo and I should have started the show over there and then done a live cut, but we just don't have the equipment to where somebody's walking around with the balance camera and stuff. But if y'all could see how good this set looks that we have to my left, it's just homey.
It's
it
done
looks
now,
really
right?
good.
Like this is. I mean, once we got there's some shelves and some unique tchotchkes.
It's good stuff. I mean, you two, do y'all feel impressed sitting over there right now?
Oh yeah, they like it.
Make you want to be a little more forthcoming about your financial life as you're sitting over there?
I like it.
Okay.
I
That's
like
great.
it.
This is gonna be good
Matt
stuff.
is like,
How do I answer that?
it does look really good though. But
so
that's
good.
all. That's all I can say.
So hey, really, in all seriousness, subscribe though, because we need that. I'd love to get us over 500,000. What's funny is I told my wife this morning, I was like, man, I'm not gonna kid you, I'm getting pretty excited about this 500,000. She goes, do you get another plaque for that? And I was like, no, that's
we
a
really
million.
should.
I think we should
I'm kind
too.
of disappointed we don't. It's such a huge, I'm excited about it. It's a huge milestone.
They say that the first 500 is the hardest. The second 500 comes much
Well,
quicker. is
maybe
what
I'm
they
hoping this is like the first 100,000.
Right.
You know, it
just
took all
compounds.
this period of time to get to 100,000. I'm hoping that the time that it took us to get to 100, we can do the last 500,000 quicker.
say. I love it. I'm in. I'm for that.
here for it.
Compounding growth, baby.
Well, are you ready to answer some more questions?
We better.
All right. Marianne has a question for you next. She says, I'm 33 with a decent amount of debt. I'm worried about time missed out of the market, so I'm maxing my Roth before paying my high interest debt, which is at 5.9%, due to the time it will take to pay that off. What are your thoughts?
Wait a minute, is the high interest debt is 5.9%?
Yes.
We might have different definitions of high
Well,
interest
maybe
debt.
you should talk
especially.
about that.
Yeah. So
Now, realize she is 33.
she's
though.
33,
Yep.
right? So 33. Let's assume first, Marianne. Let's assume that you have decided that, hey, I've got high interest debt, but instead of doing that, I'm gonna go fund my Roth. Well, you've already made a mistake here because we have the financial order of operations. Brian, we hold the thing up. We have a 9-step tried and true process that will walk you through exactly what you should do with your next dollar. If you don't have your copy of the food, you can go to moneyguy.com/resources and download your free copy. Well, step number 3 is high interest debt. And what that suggests is that if you do have high interest debt, if you have credit card debt or consumer debt or some sort of debt that in your circumstance qualifies as high interest, you need to satisfy that debt before you even build a fully funded emergency fund and before you start funding a Roth or HSA. So I'd be curious, Marianne, if you are already doing the Roth, does that mean that you also skip the emergency step phase? Because it's real bad to skip one step of the FOO. It's real bad to skip 2 steps of the FOO. So I would reassess where I am and am I following the FOO the way that I should be following the FOO. Now, you posed a very great question. At 33 years old, 5.9%. When I think of high interest debt, 5.9% is not what generally pops in my head. I'm thinking like credit cards, like 20%, 25% when it comes to high interest. Did that strike you as well?
I know probably some of this falls into. We have a great illustration when I wrote Millionaire Mission. We've used it in a lot of our content too. As we talked about, there's this spread between the risk-free rate of return and then what the risk premium that you count on when you invest. It is so hard, and this is something I struggled with when I was writing the book, is that number obviously varies based upon where interest rates. And we had been in a period for the last 10 to 15 years where interest rates were incredibly low. Now we're in a period where interest rates have been much higher, where even you could get close to 5% on your cash alone. So it's a much more, I gave a very definitive answer in the book, and we've done it in our show, but just know that there is some variability. And Marianne, you are in that kind of slightly gray zone, and that I do love the Roth account so much so that it's something to be considered, but I'm not willing to push that needle over. Bo is exactly right. You gotta have cash reserves, and I'm worried if you skip that. And then I'd also ask you about where you are in your financial career. I mean, with your career, and the shovel opportunity of income, because I think I had given a discussion with you guys is that I had a friend when we all graduated college together. She was an attorney, and she was, I mean, right out of the gates doing really well, but
Making
she
good
did have
money.
some student loans, and she was foregoing doing her employer plan because she had student loans. She was also foregoing doing the Roth IRA because she had these student loans. And I was trying to make the point to her is that, look, you're going to be making six figures within likely the next 2.5 to 3 years. And at that point, that for a single person, six figures was where you kind of phased out of the Roth IRA contributions. And so I was like, based upon your career opportunity and your income opportunity, I think you're missing out because the government's not going to let you come back and refund those Roth IRA
And this was
contributions.
pre-backdoor, I believe.
Yeah, this is before all the backdoor. This is definitely pre-2010. So, Marianne, if you're part of that, if you have a great shovel, meaning you have a career where your income is going up 10, 15, 20% every year, take that into account too, because there are moments in time, and look, without a doubt, I think based upon what I've put in the book and what we've done on shows, 5.9 for somebody in their 30s could be perceived as high interest debt. It's just, but you have to then put the overlay filter of where you are in your career, what's your income opportunities, and what's your chance that you're not even going to be able to fund Roth going forward, but outside of your employer plan. And then you might even want to have tax savings depending upon where you are in your income tax rate.
Yeah, and I think what's really interesting, 5.9, I mean, this could be a car payment. Well, one of the reasons why, or this could be a car loan, one of the reasons why we developed 23.8, you put 20% down in your automobile, don't finance any more than 3 years, and it can't be more than 8% of your gross income. Even if this is an auto loan payment, but you're following 23.8, I would argue that would then satisfy you hitting step number 3 because you have that debt management, have that. Well, then if it's car loan and it's inside of 23.8, you followed the rules, then you could move to step 4. She did say she has a fully funded emergency fund.
That's great.
So then you can go to funding a Roth or funding an HSA, but you have to do, again, a little bit of personal assessment because personal finance is personal to make sure that you're doing the most optimal decision with your dollars that you could be doing. Because every dollar is so powerful, especially for someone who's 33 years old. You just want to make sure you're using it in the best way available to you.
All right, fantastic. Marianne, thank you for your question. Thanks for being here. And I hope that helps you think through where you are in the FU and what your next dollar should be doing.
By the way, we're at the point where Nate's voice is echoing in my ears because we were like, hey, we're doing that big intro with the Federal Reserve. And he's like, look, guys, if you do it in this amount of time and then you each take this amount of time you'll be done in like 50, 55 minutes. And I'm looking at the clock right now and I'm realizing, we might have, this is probably my fault.
Who would have thought we missed the mark?
I know, this is probably my fault. Nate knew it too.
It's the profit.
All right.
That's the easy money.
For the sake of time, I'm going to move right into our next question.
Poor Reeby, the cat herder.
Oh, it's fun. I almost took you down a tangent, but you guys took me down 2 other tangents. So that's
Before
where
you
we
could
are
even get your
today, before I
tangent
could
in.
even
We
say
are
it.
the tangent
So,
kings.
That's amazing.
it was a fun time. But okay, Soaring Chef has a question for you.
Soaring Chef.
Soaring Chef asks, I'm reading into the FIRE movement right now. Aside from the 4% rule, what other potential expenses should I allocate for in retirement?
Well, it depends, right? It depends on what your life looks like. I mean, one really easy one that you want to go just get lost in some research, go see what the average retiree pays in medical costs over the course of their retirement. Like that's an expense that you could factor in. What I think is so interesting about FIRE, what I think is frankly so difficult about FIRE, depending on how fiery you want to be, if you decide that you want to start checking out of the workforce in your early 40s, mid 40s, late 40s, I'd argue there's still a lot of life yet to happen that's going to have expenses associated with it. For example, if you're someone who has children, there's a really good chance by the time you get into your mid 40s, those kids might not have even left the house yet. If they have left the house, maybe they're in college or approaching college. There's still a number of expenses that are going to be associated with that. So when you're thinking about FIRE, yeah, you can think about like your primary expenses and what's my utility bill going to be and what's my grocery bill going to be. But if you leave the workforce and then all of a sudden you got some kids you're going to send off to school and you're going to be responsible for some portion of their schooling or education, that better be factored into your fire budget. Because one thing we've noticed, and as we've done content on this in the past, Brian, is not all fires are created equal. There's coast fire, there's barista fire, there's frugal fire. You have to define for you which type of fire movement are you trying to pursue?
Yeah, well, we don't know about soaring chef is I don't know how early in this whole fire movement it is, because where I've seen just from our experiences is Bo's right. I mean, what makes your journey into retirement that much easier is that you can control your fixed expenses and the costs. That's the easiest part. Once you're kind of set, and what I mean by being set is that Bo's exactly right. You got to have the kids kind of out of the house. You got to have college kind of settled out for them, or let them know early enough on that they're on their own. You also need to know where you're going to live, because that has a direct impact on things. But I want to spend a little bit more time. This is why when people talk about the fire movement, I've been really kind of a more of an advocate for the FIND movement, which is financial independence. That part stays the same, but next endeavor versus retire early, because I've noticed when people leave the workforce early, they talk about when they're in the target at, Tuesday or Wednesday, and nobody else is in there.
Was that the target you just threw?
The target. You get to be my age. I could be part of this FIND movement, but I'm going to stick with and just add "the" to every word that I say, and make me sound a little bit older.
So when they're at the target.
When they're at the target, and people, and then they also, I've seen people, they say, "What do you do for a living?" And they start coming up with things, because it's a little weird, right? Because you think that you're going to leave and and that's going to be it. But if you don't have what your why figured out, or what your work going to, the next endeavor, this is why I like the FIND, you find yourself drifting a little bit. And then, because it's not like all your friends, unless you've really done a masterful job. And I tried this. When I was 22 years old, I gave every one of my buddies the Wealthy Barber, and I said, look, I don't want to be the only one that has the ability to retire at 50.
So you guys better get serious.
So we could all, and here we are, we're all 50 now. And I mean, and then some of them have done really good. I'm not taking it because I'm going to be hanging out with them at spring training, but we're all in different places financially.
Sure.
And so it is one of those things where your friends aren't retiring with you, so you're likely going to need to figure out what you're doing with your time, and also kind of knowing what the purpose and the why is. Because it could be somewhat empty if you haven't done that extra step. Don't just assume when you get to $3 million, $4 million, or $5 million that all of life's woes and problems will be fulfilled and satisfied. You need to do a little more work on yourself to kind of tie that stuff down. But check into the FIND movement. And then Soaring Chef, I think we gave you enough on, it's really those expenses in retirement. And if your life hasn't settled down to the controllable phase, it gets a lot harder to know that answer. But we do have, if you go to learn.moneyguy.com, we at least have the Know Your Number tool. So you can really try to run a bunch of scenarios, put inflation in there, put the rates of return in there. You can figure out, are you behind the curve, on the curve, or way ahead of the curve?
Yeah, I would encourage you, go to moneyguy.com and just search our archives. We've done a lot of FIND content. One of the interesting things is you just threw out the 4% rule. And the 4% withdrawal rule is great. It's a safe withdrawal rule.
Great napkin financial planning.
We actually adjust that a little bit because I don't think 4% always applies, because it depends on how long you plan on being in retirement. Your withdrawal rate may potentially be higher if you're going to retire later in the FIND movement, but it may actually be lower depending on your circumstances. So I'd encourage you, go check out all of that FIRE and FIND content that we've done and figure out, okay, what sort of FIRE plan makes the most sense for what I'm looking to accomplish.
Yeah, by the way, it's dynamic. Yes, if you're leaving the workforce pre-60, it's going to probably be higher. But if you're somebody who loves your job and you're going to work until you're 70, it could even get up into those higher rates that Cowboy Dave uses. You never know.
Just called him Cowboy Dave.
He'll love that.
Well, Soaring Chef, thank you for the question. That was a really good one. Hopefully that helps you out.
Come on. I mean, if you're 77 years old, yeah, maybe you can use 8%.
I'm here for it.
All right. Do you want a spicy question or a popular question next? Choose your own adventure.
I mean, spicy, right? Put a little hot sauce on there.
Let's go.
We're in Nashville.
All right. Go Cubs 1989 has a question, and he says, spicy question alert. I give 10%, save 25%, 25% for my mortgage, pay 20% in taxes, and have 2 car payments of 16% per the 23-8 rule. Are you saying I have to figure out how to live on 4% of my income?
All right, read them to me a little bit slower.
Yep.
Pretend like I don't write real fast. I have give 10%, save
25%.
You
25%.
should check this math. That's true.
Taxes 20%. Car 16%.
Yes.
Wrong.
2 car payments, which I know you're going to talk about. And did you get that? He gives 10%, saves 25% for mortgage.
25% for mortgage.
Yes, that's the one I think you didn't have.
Well, you've done one thing interesting, Go Cubs. You chose, and this is fun, to go at the top end of all of our metrics. Yes, we say that when it comes to your mortgage, your total housing cannot exceed 25%. What we're not saying is that you should shoot for maxing that out at 25%. What we'd love to see is if the housing cost was some number less than that. Maybe it's 20%, maybe it's 21%, maybe it's 15%. That'll give you a little bit of reprieve there. The other thing that you did, and this is the biggest error that I see, is that you said, hey, I've got 16% going to car payments. That is not the way the 23-8 rule works. The way the 23-8 works is you have to put 20% down when you buy a car. You cannot finance for any more than 3 years or 36 months. And all of your car payments combined, whether you have 1, 2, 3, 5, 10, 12 cars, cannot exceed 8% of your monthly gross income. So I would argue if you're at 16% for your cars, you have doubled that. But since you use all the numbers, I'm going to assume this is a hypothetical. So let's back that down to 8. We just gave you 8% back. So now you have 12% that you theoretically could live on. This is not any different than folks who are in the messy middle. This is not any different than folks who feel like they have 1,000 different things pulling them in 1,000 different directions. I think what you have to figure out, what you have to really lay into is how can I get my lifestyle footprint as small as possible? So if I am in that 25% mortgage, if I'm thinking about buying a house, maybe I don't want to go to 25%, maybe it should go to 20%. Are there other areas that I can squeeze and get my footprint down? Or if I can't spend less, if I can't get my numbers down, how do I then think about getting my income up so that these things that are expenses that are pulling on me are a smaller percentage of the total gross income that I'm working with?
I love that the spiciness was this was kind of a gotcha, but I love because it shows how we've actually taken into account and done the nerdy stuff. And let's go through a few things. If you go to moneyguy.com/resources, we actually, and I know it's not titled this, but this is what I call it every time, and we ought to just change the title of it. What will 25% do for you? We have a resource, find out how much you need to save. I think that's what it's actually titled, and we've put it up on the screen right now. 25% is aspirational for people in their 20s. Right. I know that. I mean, but I want you to start somewhere. I don't care. And what I love about that illustration is it shows 10% is pretty daggum good in your early 20s. 15% is outstanding in your late 20s. It's really by the time you get in your 30s, you should be really trying to get into that 25%. The mortgage, I think about myself. There are seasons in my life where I maxed out that 25% of housing, but now I look at where I am, and my housing is almost like a rounding error in my life because my house is pretty much paid off. If you look at my living expenses or the housing expenses compared to what I make in income, I mean, we're not even close to 3, 4, even 5%. So I think that there's some actual flex for my super young people who are watching this, my financial mutants. You are in the aspirational side on the savings rate of the 25%. You're probably not going to have a mortgage at that, so there's going to give you some squeeze of the balloon or play with the numbers. And for Go Cubs, Bo's right. The messy middle's the hard part, that 30s, because I'm kind of hoping you are in the 25%. I'm also know you're probably going to need to buy the house in that phase. So that's why you are going to get squeezed where you're both short on time, you're short on money, but it's still your money is so valuable. And go to the wealth multiplier at moneyguy.com/resources to see why we say this works. But that is the hard part. But then once you get into your 40s, This gets so much easier because your income is now reaching peak earning potential. Your housing is set, and it's getting to be a smaller and smaller cost of your total expenses as a percentage, and it all kind of fixes itself. So go Cubs, you did a great job of trying to lock it down, but I think I've just showed you there's enough play in the system. We've lived enough life. We've worked with enough wealthy people. We know how this all kind of is going to play out for you, and we've tried to equip you with all the tools so that you can navigate it well and not have regrets once you reach each step in this journey.
It's great.
That was a good one. Not quite as spicy as maybe you thought. Honestly, just a really good question. So thanks for asking it.
Well, this is that intersection of experience and kind of been there, done that, and kind of knowing. I mean, it's one thing if you, in theory, you come up with a hypothetical and then you have a hypothesis of what you think would work. It's a different thing when you've walked this not only for yourself, but also for hundreds and hundreds of people, and you know what kind of works. And that's why I think that people love our content, is because this isn't somebody who just got excited about personal finance and now we're trying to just share some of the basics that you read about in a book. This is actually the experience, and this is why when I got on fire, and I was like, man, my biggest regrets in life is that when I was 22 years old and realized I wanted to live life differently than what my parents could do, I didn't know where to start. I didn't know, but it's not like somebody was laying out, and I got fortunate that I read Wealthy Barber, I read Millionaire Next Door, but still, like, one was good on some basics, but others was giving you stats. I was like, somebody needs to give you the roadmap, the actual instruction manual, and that's what I did with Millionaire Mission.
That's great.
True that. We're going to do the popular question next, but Bo, there's been so much chatter about it, I have to mention it. Everybody wants to know what is up with your beard. Because it has appeared over the past few weeks.
Do we call that a beard? Because it got bald spots.
I mean, that is up for grabs.
Do we call a beard if there's bald spots?
Fired. Ouch. I don't know. We'll see.
Is it graduate beyond shadow?
That's okay. There, look. Yeah, right.
Well, now you know the reason I can pick on him is because we actually did this. Goes back. This is back when we were in Georgia. Bo and I did the No Shave November, and I actually went a whole month. I'm even worse than Bo, so that's why I can pick on Bo because I can't even grow what Bo can grow. But so I think that gives me since he knows that I can't put out anything better, it's like I'm picking on him from a much lower position.
We're gonna see. We'll see where it goes. I don't know. Every morning I wake up, I'm like, all right, looks all right.
And remind me, is your wife like this?
Yeah, she thinks she
as
loves
long
me.
as she's on board. I mean, there's not much we can say.
She's great.
I don't like
she
it.
wins.
She thinks I'm
But Bo quit worrying about what I like years ago.
We did do a poll, and 17% of responders said shave it off.
Okay, that's a low
But
percentage.
the highest percentage was 33% who said you should grow your beard to lumberjack status.
Done.
Okay.
I don't know if
Was there a third option? I have a third option.
Yes, there were a few. 20% said keep some scruff, so they like what you're doing now.
See?
Okay.
And then 27% said Gandalf level beard.
Oh, that.
Do you know who Gandalf is?
Yeah, he's in ZZ Top, right?
No, he's being funny. He knows who Gandalf is. I have an option that probably didn't make it on the survey.
I walked right into it.
He should have shaved off a little bit and put it on his eyebrows.
Oh, wow.
That was good.
Double shot.
That was really good.
Holy cow.
Look at Matt over there. He's like, did he say that out loud?
Oh, wow.
That comes from a place of jealousy.
Okay. Okay.
If only Bo,
Okay.
I know you have plenty of confidence, so it's okay.
It's true.
Me and his
takes us all in
spouse,
stride. That's the
me and
only
his
reason I was able
wife
to bring
are
it up.
always like we have to carry around a big stick and
Just
pop him
to
around just to
keep me nice.
keep him in check.
Someone
Keep me
has
nice and
to.
humble. I like it. I'm here for it.
All right. Well, that was good. We got a lot of comments the last couple of weeks, and I was like,
Well,
Just give him a chance to
it's probably
speak to
months because it's not like Bo grows this overnight.
this is true.
He's still throwing
I'm on fire. I mean, these things are just coming out. Do you see these things? They're
It's
just
because Nick and
rolling.
Matt are over here rolling on the floor practically, and Brian's
This
just
attack
like,
was locked and loaded. All right.
got an audience.
Oh man.
All right. Okay.
I shouldn't be so entertained by this. By the way, subscribe. We're trying to get to 500,000.
Hey, thank you for giving the people what they want, Reby.
They really
we
wanted
care
to
about the
know.
questions that
Yeah.
you guys care about. So you ask
By the way,
us, we'll answer.
Nate, when he picks on us post this show and the next show we record after this, and it keeps us from eating our lunch, he can now point at you too.
That's right. It's on you
Reby
guys.
is also causing this thing to drag on.
Hilarious.
Well, I'll take the hit. That's
This,
fine.
this is payback because I ended last week's show 10 minutes early.
You're making up
Now
for it now.
we're giving
just
you a little
adding that
extra.
back.
We are making up for it.
Okay, I do have one more question that we've gotten a decent amount recently, it feels like. So, but it is about personal finance, don't worry. David L asks, he says, "Hi, Money Guys. What would you recommend doing with excess 529 account funds if you don't plan on future schooling? I heard in 2024 that you could use the 529 funds to max your Roth IRA. So, one, is that true? And should they do it? And what other options are there for people who find that they have extra funds in their 529 accounts?"
Yeah, when this legislation first passed, I think we all, financial mutants, we got
Like,
so
woohoo!
excited. We're like, oh, my, there's a huge opportunity here. Holy cow, this is going to be an amazing thing. And it's a positive, but it's not an amazing
Then
thing.
we saw the butts.
Yeah, there's a bunch of stuff to it. So here's what ends up happening. If you end up in the position where you have extra 529 assets, those assets can then be used to fund Roth IRAs for the beneficiary, and you can do up to $35,000 for the beneficiary, but it's limited each year to the maximum contributable amount. So it's like $7,000 a year over the course of 5 years, and it's not like it's in addition to what they could do on their own. It actually eats up their availability. So if you have excess 529 for your kids and you fund a Roth IRA, they won't be able to fund their own Roth IRA because you will have funded it from the 529. Now again, yeah, that's certainly a better option than having to pay taxes and a penalty on withdrawing those funds. But I think this is more of like a catch-all provision than like a planning provision, because most
There's
of the,
one other thing you ought to share. They have to be around for 15 years.
Oh, yeah, that's right.
These
It can't be a
accounts have to
new-
be around
Yep.
15 years.
That's exactly right. So we think when it comes to 529s, one of the things you ought to consider before you start thinking about funding Roths is, okay, are there other siblings, other beneficiaries that it might make sense for us to roll this too? So if you have multiple kids, maybe you overfund the oldest child's, and then whatever's not used, you roll to the next child, the next child, and you do it that way. And this can pay for not just like traditional four-year universities, but this can go to vocational schools or trade schools, or it can go for graduate level degrees. So I think the best way to use 529 assets is to use them for higher education. But then if you do get to the end of the plan and there are dollars left over, it's nice that now there's another outlet to be able to exhaust those assets, as opposed to just paying the taxes and penalties.
I think you just nailed it. What I would summarize this is of course, look around your household, see if there's any other educational goals that need to be funded in a tax efficient, even tax-free way. So that's why I think siblings, don't sleep on yourself. You might, if you ever thought about, hey, I want to go back to school myself to get a degree or something, you can, look around the house and see if there's any education opportunities. If the answer is no, then, and you say, yeah, I think this account's been open over, the 15-year requirement. I'd love to use this as a tool to prime the pump of good behavior for my child who's getting out in the workforce. By all means, because think about this, your first year out of school, you're probably not going to have a great salary.
Mm-hmm.
Nobody comes out unless you're a professional athlete or you're a performing artist like Justin Timberlake or somebody like that.
Or you've been in school for 10 years.
There's very few people that come out making great money because you got to get that experience and you got to get the mastery of whatever your skill is. So it'd be great if you're not going to be able to maximize $7,000 naturally. Why not do what I've always talked about? Let's prime the pump and do a dollar for dollar match with your child, that you say, look, if you can save $3,000, I'll put in $3,000. Or if you can put in $3,500, you figure out the matching formula, but use this as kind of that carrot to get that behavior of saving and investing for the future to take hold and really start to grow some roots so that they not only have the education that you planned for, but you also got the behavior of creating automated, always be buying type behaviors to get the best result possible. And that's a functioning, independent, financial mutant child that is going to be able to keep bearing fruit for you for many years, as well as being self-sustaining. Because remember, when we talk about Millionaire Next Door, when they talk about traits of what millionaires do, it's not only they allocate their own resources well, it's that their adult children aren't dependent upon them and their success. So let's go ahead and use this as a tool in that endeavor.
That's great.
Awesome. David L., thanks for asking the question. And we just always appreciate hearing what you are actually thinking about. So we just try to continue to give you opportunities to let us know what's going on in your personal financial situation so that we can speak to it and hopefully kind of bring some peace to that chaos and help you focus on what really matters and be more confident with your money. That's what it's all about. So thanks for joining us in that pursuit every Tuesday at 10 a.m. Central right here on the live stream. Remember, the show continues on anytime you need it over at moneyguy.com, not only with our archive of episodes, but with tons of free resources covering these topics and more, and our courses and tools as well, and Brian's book. Like, it's all there anytime you need it, moneyguy.com.
Yeah, we're giving you mindset. We're helping you maximize. And I like to share this often, is that there is definitely a better way to do money, and we're going to keep it coming. I'm your host, Brian Preston, Bo Hansen, Money Guy team, out.